Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, June 25th, 2024 edition of Trading Places live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another market day. It does look like we're getting a little bit of a rebound in futures, or at least we were. Let me give you a quick update there in terms of looking at some of those technology names, semiconductor stocks, which have been under so much pressure since the beginning of last Thursday. I did see earlier that the futures had turned a little bit in their favor. Currently, we got the diamonds, which track the Dow Jones, down a little bit more than 0.1%. The spider is up about 0.2%. The QQQ is up nearly 0.5%. And then the IWM small cap index down almost 0.2%. So a little bit of a flip here at the open in terms of how the money is being distributed going into the market. Recently, we've been seeing the Dow doing better. We've seen the Russell 2000 doing better. Transports have picked up. It's really opposite George week. I talk about it a lot. Max Payne week and a little bit after Max Payne. When you go into the following week, still got market makers on the hook from any options holders that exercised their in the money calls from last week. You've still got market makers on the other side that are shorting the stock. So still have potential downside in the at least the first 2 or 3 days after options expire. I've talked about it often on here. The Monday that follows option expiration Friday is typically the worst day for the stock market. And this dates back to 1950. This isn't something that I'm just looking at this year or the last couple of years. This is something that's gone on for 75 years. If you look overall at the stock market, the S&P 500, it goes up roughly 53% of the days since 1950, a little bit more than 50-50 chance of the stock market going higher. On Mondays that follow option expiration Friday, that percentage drops to 37%. So it's not a slam dunk. I never say it's a guarantee that we're going lower, but the tendency is that we do have more down days on these Mondays that follow option expiration day. So yesterday really was no different than what we typically experience. We saw the S&P 500 drop. Of course, the NASDAQ got hit much harder. Technology, semiconductors. As we go right down that list, the losses only grew in terms of percentages. But there were other areas of the market that picked up the pieces. When we saw that money rotating away from semiconductors here over the past few days, it's found a home in other areas, which is why we're not seeing a tremendous sell-off in the overall market. Rotation is a bull's best friend, and it's a hallmark of secular bull market advances. So it's nice to see the money, or that the overall indices are holding up, even though semiconductors have been absolutely slammed. And semiconductors are a big part of the market. Semiconductors are about 50% of the technology ETF. They're about 25% of the NASDAQ 100. They're about 11% of the S&P 500. So when this group goes down, it's normally not a good thing for the overall market. But when that money comes out and finds a new home in other areas, that's what helps keep the losses, at least at the major index level, somewhat lower than what you might expect, especially if you're just looking at these individual names in the semiconductors. Yesterday, NVIDIA fell down, I think closed around a 118 level. On Thursday at the open, just after the open, it was trading up near 141. Now today, or yesterday at the close, it was trading at 118. That's about a 16% drop in 3 days in NVIDIA. And many of the other semiconductors fell in sympathy, many of them falling more than 10%, maybe even into that 15% range. And as a result, we saw a lot of weakness in the NASDAQ 100. But today we're getting a little bit of a bounce. It could just be a little bit of an oversold bounce. It'll be very interesting to see how things evolve after the opening bell and whether or not we can sustain a move back up. I wrote about over the weekend at Stock Charts. I've talked about it. I wrote about it last Friday morning in our EB Digest, our free newsletter, that I think semiconductors have topped. And I don't mean forever. don't get carried away. I still love the semiconductor group, but I just think the trade is too crowded. I think too many folks have gone in. It's just been an ambush on the long side into many of these semiconductor names. I just think they need a rest. So I don't think it's anything horrible. It's just, hey, when you go up, the semiconductor index went up from 900 to 2100 since the end of October of last year. So that's 133% in about 8-9 months. It's just too much. It's not that the group's bad. Anybody jumping into NVIDIA at 140 is going to swear it's the worst stock in the world, especially if it keeps going down. It's all about timing. So I just think you want to stay away from that group for a little while. I mean, if you catch a rebound, you get a couple dollars, few dollars out of a rebound, that's great. But otherwise, I'd be really careful with the group, probably for at least the next few weeks. But we'll see how it all evolves, and we'll take it from there. Anyhow, let's take a look at what happened on Monday to open the week. Again, it was the Monday following option expiration Friday, monthly option expiration Friday. And so I never really have a lot of expectations. I think it's still part of Opposite George Week, which is a Seinfeld reference. For those of you Seinfeld fans out there, you probably know exactly what I'm talking about, where George, everything's going wrong in his life. He's complaining, and Jerry comes in and says, hey, just switch everything. If every decision you make is the wrong one, just do the opposite. And so George starts doing the opposite, and his life completely turns around. It's a really funny episode. Anyhow, that's really what the stock market does for option expiration week and into the week following. It's Opposite George Week. Whatever wasn't working, all of a sudden now starts catching fire. Look at the Dow Jones. Dow Jones, you can see the S&P 500 was breaking out the new highs. NASDAQ was breaking out the new highs going into option expiration week. And the Dow was way below, had broken out back in mid-May, and had actually fallen quite a bit and was trying to get its feet under it. Well, Opposite George Week certainly helped. You can see the Dow moving up. The S&P, which had been doing so well, struggled and pulled back. NASDAQ 100 moved up, was very strong throughout most of June. All of a sudden, we get into option expiration week, and the selling kicks in. Really, since Thursday's open, that's when we've seen most of the selling. And that's the other thing. It's not like, the history doesn't tell us that the Monday of options expiration week, it's just going to immediately start to collapse. I wish it was that easy. Sometimes we see option expiration kick in a little earlier than expected. We can even see a top a little bit before option expiration week. Sometimes we see it early in option expiration week. Sometimes we see it later in option expiration week. Sometimes we don't see it until the Monday or the Tuesday following option expiration week. And sometimes we don't see it at all. This isn't a guarantee. I get a lot of folks sometimes will write in and say, hey, what happened? Max Payne, all these in the money calls and the market kept going up. I just shrugged my shoulders. It happens. What I use Max Payne for is to evaluate risk. That's it, not to provide a guarantee. So last week, when we held our Max Payne event, which was last Tuesday at 4:30 p.m. Eastern, so it was after the market closed. Of course, we were closed on Wednesday. So on Tuesday evening, what I said was, if I was looking at a stock like NVIDIA, which was trading at that time at an all-time high, closed at 135 or thereabouts on Tuesday, I said I would hold off. If I wanted to buy NVIDIA, I wouldn't buy it at that price. I would hold off because Max Payne, all of the in-the-money call premium that was out there, the net call premium on NVIDIA, suggested to me that it could take a big hit. It could. Didn't have to. Some months it doesn't, but it could take a big hit. So if I'm truly trying to manage my risk, I don't want to jump into an NVIDIA when it's got that kind of in-the-money call premium. And so what I said is, if I was looking to buy NVIDIA, I'd simply wait a week. Well, if you waited a week from 135, it actually gapped up on Thursday to above 140, and yesterday closed at 118. So as it falls, all of that Max Payne related risk is literally leaving the stock. So would I be opposed to buying NVIDIA here at 118 and holding it for a long term? No. Much better than 135 or even 140, where we opened on Thursday. So that's what Max Payne is to me. It's simply a means of evaluating risk and trying to make good trading decisions based on risk. Anybody who's not paying attention to Max Payne, never heard of it, doesn't understand how options work, simply went into Thursday morning with a big gap up on NVIDIA thinking the same thing they've always thought. NVIDIA is just a great stock, just going to keep going higher. Max Payne presents a short-term market inefficiency that we need to be aware of. And if you're not aware of it or you don't understand it, you need to join us, 30-day free trial, and make sure you're in for the next one, which will be the Tuesday before July monthly options expire on the third Friday of July. So what's that third Friday? I don't know. This Friday is what, June 28th? So that would make Friday, July 1st. Or no. That would make Friday, July 5th. Yeah, the 4th is on a Thursday. So July 5th would be the first Friday. So that means July 19th is the third Friday. The Tuesday before is July 16th. Mark it on your calendar. You could join now, 30 days, try us out, and come to that Max Payne event. It's just one other way that I evaluate risk, just like I do when I use negative divergences or talk about the AD line rolling over, even though prices are going higher. Breakdowns on, price. Obviously, that's a big one because price, the charts, price action volume, that's our number one primary indicator. Everything else, including Max Payne, is a secondary indicator. But it's still very, very important, and you need to be aware of it in order to effectively manage risk as a trader. Now, what I said last week was if you're a long-term buy and hold investor, this is a short-term issue. You probably look at your account, or if you are looking at your account, you probably saw it go down, especially if you got many semiconductors in your portfolio. But again, I think it's a short-term issue. Maybe we get weaker in the near term on semiconductors. That would not shock me at all. After the huge move we made to the upside, maybe pull out those Fibonacci retracement. Take a look at where we might see, looking back at like a 38% retracement or even a 50% retracement of the most recent advance. Those will give you some signs along with moving averages. Anyhow, let's get back to this. Mid caps jumping almost 2/3 yesterday. And again, this is a group that had been beaten down, and now all of a sudden you go into option expiration week and we have a nice move. IWM, same thing. We were down about 197, 198. Yesterday, I think we got up to 202 and change, maybe almost touching the 203 level. We did fall back at the end of the day, but still, last few days have been up for the small caps. How about transports? Talk about opposite George week. We were just breaking down right before option week kicked in, and now look at what transports have done. Literally, we went from a 2024 low to a 1-month high during this whole option expiration period. So it was an area of the market that looked absolutely horrible, but opposite George week picks it up, and all of a sudden it's one of the better performers. Transports were the best area of the market last week of the major indices. These 6 indices that I look at the beginning of every show, transports hasn't happened often, certainly not in 2024 very often, but transports actually led the other 5 indices last week. Pretty interesting. All right, moving on to the sectors. We had energy and utilities leading yesterday and recently. Guess what? Those groups have been in a downtrend, opposite George week. Utilities in a downtrend, opposite George week. Staples, the third one, trending down near the 50-day moving average, opposite George week. Now we're ready to break out. How about oil equipment services? This was the best performing industry group yesterday. Been in a very lengthy downtrend, cleared those lows back in February, and then go into option expiration week, and all of a sudden, it's a superstar. Food products getting absolutely killed, 2024 low, heading into option expiration week. Now we're back up above, closed just above the 20-day moving average. This is what I'm referring to as opposite George week. When I start talking about it, many times these groups that have been performing so poorly absolutely fall apart. And then you look at the absolute best area in the market, semiconductors, which have been on fire. You go into option expiration week, and it literally started on Thursday at the open. We gapped up, and then a very significant sell-off. And I've been talking about, I could see semiconductors back in the 16,000s. That's just where we broke out from. We had a big gap up toward the end of May, clearing this prior top. it wouldn't be anything wrong technically on this chart for semiconductors to drop back to 16, maybe 17,000. So here's 16. We actually broke out. It was probably more like 16.6, something like that. But if we move back down in the 16s, I wouldn't be surprised. And at that point, I think the reward to risk starts to turn much more in favor of semiconductors. Because I think what's going to happen, I think we'll have some sort of a sideways consolidation with a downward slant, kind of like we did back when we hit the high in March, pulled back. It was really throughout the selling in April, and it wasn't until early May that we finally started to move back up, clearing the moving averages and trending higher again. So I wouldn't be surprised to see a month of weakness. It's not going to be, I don't think it'll be straight down. It could be, but I don't think it will. I would expect that we'll see some strength along the way, little bounces, and then another push to the downside, then maybe another little bounce and so forth until we finally work our way back to at least under that 17,000 level. And then we'll see what happens from there. So today might just be a simple short-term gap. To the upside. I think that's probably all it's going to be. If you look at the semiconductors up close, let's take a look at a 5-day chart. And if you look at the last 3 days, this is where we gapped up on Thursday, and you can see it's almost like we've been in this channel. So, we had a little bit of a bounce back on Thursday morning, and then we saw more selling. Then we had a bounce in the afternoon, some selling, a little bit of a bounce, selling into the close, gap down, recovery, more selling, gap down and selling in the morning, back a little sideways action, a little bit more selling, gaining. Now we drop, close at a new low, and now this morning we're going to start up again. Do we just start taking off to the upside? It's possible. I would put less than 50% odds on it. I just don't think it's happening. Not yet. I think that we're going to continue to put in lower highs. So yesterday's high was around 19.3. Do I think it's possible we could see semiconductors up close to that level at some point today? Possibly. I would think maybe 19,000 might be the top that you would see today, even if we are strong. I'd really be surprised if we were to get back through 19. So I'm looking for weakness in the semiconductors. I'm not really overly interested. I get it if you've been looking to get into something like NVIDIA. It's a lot cheaper now than it was 3 days ago. You could start to build a position, but I would keep some powder dry because I don't think the selling is over in the semi space. Moving on to the 10-year Treasury Yield, give you an update here. We do have the Case-Shiller Home Price Index. Actually, I think it came out right as the show was starting. So let me see if I can get that for you. It is the expectation was for a rise in the Case-Shiller Home Price Index. Actually, I don't show the month-over-month consensus. I can tell you that for the month of March, it rose 0.3%. For April, it rose 0.4%. But we're looking quite a bit in the rearview mirror. We're getting ready to go into July, and we're getting the April Case-Shiller. So this is a report that's way in the rearview mirror. It's not one that I really follow very closely. I think that there are other housing reports that are going to be much more meaningful to traders. And so I don't pay much attention to it. We'll see what happens. 10-year Treasury yield, though, clearly has been in a short-term downtrend. Watching the area right around 420. I think if it breaks down, I think it's just a further signal from the bond market telling the Fed that they need to start to hit the brakes and bring those interest rates back down. Whether the Fed's listening, we're going to find out the next meeting. They don't seem to have a very good job. They don't do a very good job listening sometimes to what the markets are telling them. And they tend to act a little slower than they probably should. That's been the history of this Fed. So I'm not holding my breath waiting for a rate cut at the next meeting, but I think they should. We'll leave it at that. S&P 500. So here was the big move up. And you might look at this and say, well, Max Pain really hasn't worked. Well, what I always say in our Max Pain webinars or sessions is that it's a directional clue. That's all. So Max Pain was actually calculated for the S&P 500. S&P 500 was 10% below. Max Pain was 10% below current price. Now, have I seen Max Pain reached within a week of our session? Yes, I have. I've seen some of these big, potential drops actually come through and see big actual drops. But what I typically say is don't expect it to go down to max pain. But I would expect it, if I'm being honest, I would be looking for a directional move in the direction of max pain. So if max pain's 10% below, sometimes what I say is, what would a 20-day test mean? It wouldn't really mean anything. It'd just be a normal test. That's what we get during uptrends. But from a max pain perspective, it would save market makers literally billions of dollars in what they have to pay out in terms of premiums. So anyway, you've got max pain as one consideration, and I think it's worked, quite honestly. I mean, since we were up near 5,500, and right now we're at 5,447. So we've made a directional move toward max pain. That's really all I'm looking for. And it tells you that you need to be careful of those areas that have been strong. And if you're going to invest, maybe go into areas that have been weak. It's one of the few times that you'll hear me talk about a stock that doesn't look very good technically. And I might say, yeah, I could hold my nose and buy that one right now because of max pain and the opposite George week effect. NASDAQ 100, you can see the selling a little bit more pronounced, but that's because it is much more heavily represented by semiconductor stocks. Like I said, 25% of the NASDAQ 100 is semiconductor related. 11% of the S&P is in the semiconductor area. So you got more than a double impact in the NASDAQ 100, and you're seeing that. We had that big top. We've been selling off. Saw the huge volume on Friday. Don't get overly concerned about that because, number one, if you look back to the quad witching days, which is it's the Friday 4 times a year. It's the Friday where you have a lot of different options, contracts, futures, everything come together and all expire simultaneously. And as a result, you get a lot of volume from folks that are just kind of readjusting portfolios and so forth. So volume is always much heavier. So if you look at what happened last Friday, I wouldn't read into it saying, oh my gosh, look at that massive volume on Friday. Thursday volume was pretty heavy. And that to me was more meaningful than the Friday because that accompanied the big reversing candle, the bearish engulfing candle. But if you look at that heavy volume, I mean, go back to March. You see it there. That's the third Friday of March. Same thing, quad witching day. How about the third Friday of December? Quad witching. Third Friday of September, quad witching. So it's always those days, and you can see there, most of the heaviest volume days of the year, if not the 4 heaviest volume days of the year. So, pay little attention to the volume on those days because we already know they're going to be extremely heavy. Moving on to IWM. IWM actually has come up this week and the end of last week. I wouldn't exactly say we're flying to the upside, but I think the IWM has benefited from some of that money rotating away from the technology area, particularly semiconductors. Transports. Now, here's a much, much bigger move. I mean, we were down, what was this? This would have been last Thursday, a week ago, like 10 days ago. And you can see that was the day we put in the hammer. We had the false breakout. I even talked about that hammer saying this is a good short-term signal for transports. And with options coming up, option expiration, you can see took full advantage of opposite George week and went back up and threatened a breakout, but failed. Long tail failure. Short term, this is not setting up so well. Until we get a breakout above say, about 15.3 on a closing basis, I would say that candle right there suggests maybe we're going to go back, see a little bit more short-term weakness. We'll see. Moving on, earnings beats. If you go over there, that's my home on the internet, earningsbeats.com. If you scroll down, we have a place where you can sign up for our free newsletter. I spend a lot of time providing some really good content for this newsletter. Yesterday, I'm going to show you a chart that I featured in the Monday Earnings Beats Digest. Going to have a similar one coming out tomorrow, highlighting companies that love the month of July, and in particular, just the first month of all of our calendar quarters. What's so special about the first month? It kicks off earnings season. So you get a lot of pre-earnings run-up. and some companies benefit from it more than others. And so that's kind of the theme this week, is talking about those types of companies. We are eliminating our Friday EB digest, so you can ignore that. This is the first week of that. So we are going to continue to do Mondays and Wednesdays, which is still 2 times a week, talking about individual stocks like the ones we're talking about this week, talking about relative strength, talking about earnings, gaps, candlesticks, sentiment, all of these various things that help you learn more about the market and potentially help your trading. So if you haven't already signed up for that, I think it's a great free newsletter, great value. I would hope it's great value because you're not paying anything. So it should be pretty good value. Anyhow, name and email address, no credit card required. Love to have you. This group is large and growing. We're talking about the tens of thousands of members. So if you're not in, you're missing out on something. Trust me on that. Check that out. Make sure you sign up. And if you want to sign up for our full paid service, we do have a 30-day free trial. So you can sign up. You will have to give your credit card so that we can get you set up in our system, but you will not be charged until the end after 30 days. And we will reach out and let you know that your 30 days is up. We don't want you paying for the service if you don't want it. Anyhow, chart of the day. So here it is. This was in the newsletter from yesterday. This is Marathon Petroleum. And you might look at this chart and say, well, what's the redeeming quality here on the chart? Well, I'm going to just zero in over here on the last couple of months, because as the stock's been going down, you can see that PPO was going down right with it until it got to this low. We put in this hammer, bounced, kind of held this level for a while, and then went down and had one close below it right there. And on that low close, you can see the PPO is much higher. We have started to move up. Haven't gotten through the 20-day moving average, but if we do, I think it's going to be a quick trip to the 50, which is up close to where our overhead resistance lies, between probably 180 and 185, maybe 184. And so getting back through the 50-day moving average would be a much, much more meaningful breakout. Above the 20, again, to me, suggests maybe we go up and hit that 50-day, test the 50-day. But if we can get through the 50, we could really move as we head into July. And I mention this because if you look at MPC, Marathon Petroleum, down here at the bottom, you can see this is 5 days. Let me just kind of zero in again. Here's 5 days. And as I pull this back, I want you to watch July. Now, we don't have July of 2024 yet, right? Hasn't started. So when you're looking at a 5-year chart and you're looking at July, it's only 4 years. So of the 4 years, July's gone up 3 out of 4. We're talking about MPC has gone up 3 out of 4 Julys. Now, as I go back every year, I want you to watch this 75% number and watch it grow. So there's 6 years. Now it's 80. 7 years, 83. 8 years, 86. Notice every year I go back, that July percentage just keeps going up, up, and up all the way to year 16. So we went down, I believe it was in 2020 or maybe 2021. And since then, or prior to that, there were like 12 years where it went up every year. And since that year, there have been 3 more years that we went up. So it's gone up all but 1 year since the financial crisis of 2009. That's a pretty strong track record. The average July increase for Marathon is 5.8% over the last 15 or 16 years. Well, 15, because we don't have one for this year yet. Haven't gone into July 2024. Anyway, 5.8%. That's a lot. That's a solid average return for that month. Now, I would feel better if the next few months were solid as well, but you can see August, September tails off. But for whatever reason, look at October. This is another earnings month. So there's October, there's July. Clearly, these 2 months just stand out like a sore thumb, don't they? So for whatever reason, it likes the first month of the quarter. You go back to April, 67%, January, 67% as well. And if you add up these totals, these averages for these 4 months, January, April, July, and October, you have 4.8, 6.3, 12.1, 18.8. That's the average return for 16 years, just taking the month of earnings, the first month of each calendar quarter, 18.8. Now let's talk about the second month of each calendar quarter. February, 2.6. May takes it down to 2.2. August takes it down to 1.9. And then November, a big jump that takes it back up to 6.3. So 6.3%. Nowhere close, though, to 18.8. And then let's look at the third month. March, 2.5. June, 0.3. That's 2.8. September, -1 is 1.8. December, up 1.4. That's 3.2. So it's 18.8, 6 and change, and then 3.2. So you can see that first month is always the month. And when you look at the chart, it's got a positive divergence. We're just waiting on that positive divergence to kick in. So this is actually one thing from a seasonality perspective that I'm actually putting a lot of time into right now, because what I'm finding is that there are a lot of companies. I did a historical analysis, and it's 9:31, so I'll try to wrap this up really quickly. But I did a historical analysis recently. Many of you got copies of it, where I laid out during the secular bull market how 16 of the most popular stocks had performed. You know, talking about Apple and Microsoft and Nvidia and Meta and Tesla and Google and Amazon and I don't know, Chipotle and Costco, or actually I don't know if Chipotle was on that list, but Costco, Netflix, Starbucks, Amgen. It's getting close to the 16, but anyway, a couple others, Broadcom, AMD, getting close. Anyway, those stocks were all featured. And what I found was those stocks had this tendency, all of them, even though they're the best stocks, they had tendencies of when they tended to go up the most. And NVIDIA, I've nailed a couple times since then. And if you've been following that pattern, you've probably nailed it too. NVIDIA loves the second month of each quarter. So we're talking about February, May, August, November. It's when it gets most of its gains. It's when it reports earnings. So that's when we're getting the pre-earnings run up. And so I'm doing this right now for all 500 S&P 500 companies. So Marathon is one that came up on the list that loves the first quarter. And we're getting ready to go into the first quarter. So that's why I'm sharing it. But eventually, I want to put this together for hundreds and hundreds and hundreds of stocks, because I think it's that important to follow. Every stock goes through periods where it's going to, run up in price, and then you're going to go through periods of profit taking. I think this is going to help us highlight the periods. But let's keep moving here. I wanted to show you the XLK technology. Clearly, this group is taking it on the chin, or has been taking it on the chin, getting close to its 20-day moving average, but also getting a little bit of a bounce. Hopefully this morning. We'll see. Let's pull that up. Yeah, but it's already a filled candle. So in other words, the gap up, we've had no follow through here in the first few minutes. We'll see if we get follow through, but I have my doubts. Maybe a little bit in the morning, but I would expect probably by 10:30, 11 o'clock, if we haven't already started going lower, I think we probably start to head lower. Semiconductors, clearly semiconductors. Let's get an update here. And again, kind of gapped up, moved up just to right around the 20-day, maybe just above. Can we hold it? If we don't, if you see new lows, probably not a good sign in the near term for this group. I wanted to also mention the XLC because we had a false breakout on the XLC. We know we've been talking about the XLC communication services, saying that 84 to 85 is long-term resistance. I can pull up a weekly chart and show you that. Here in 2021, we got up between right about to 84. And then in early April, got up to about 84. And more recently, we've kind of moved up to 85, just barely eclipsing these prior highs. But again, if you go back, you can see we're moving up with a negative divergence on the weekly chart and also on the daily chart. False breakout there. And you can see the PPO coming down. So XLC may struggle here a little bit. Technology, we already know, is under pressure. This could lead to some other areas of the market performing better. I'm looking at discretionary stocks. Watch for a breakout over 185. How about healthcare? We already had this move up, got a slight breakout, pulled back, and now we're right back up to the highs again. Excuse me. Watch for a breakout here. XLF Financials on a run here with opposite George week. It too has overhead resistance that you're going to want to keep an eye on. XLI Industrials sideways consolidating. These typically break out in the direction of the prior up or the prior trend, which in this case is an uptrend. Uptrend, you've got equal highs, you've got equal lows. You had a hammer print right at 120 support, and now we're moving back up into the middle of this range. Ultimately, a break above 126 would be very bullish. So if we do see selling continue in technology, in those semiconductor stocks, and in other areas where we've seen a lot of strength, watch the other areas that have not been breaking to new all-time highs consistently, that have instead been consolidating or even flat out been weak. Those are areas that we could see some more money rotating into. Anyhow, let's take a quick look now at what's going on in the market. So we got the Dow down 23. We've got S&P up 7, NASDAQ up 70, which is 0.4%. So there's your leader. NASDAQ 100, which is a little bit more aggressive. Usually you see that doing a little bit better than the NASDAQ. Instead, we're doing just a little bit worse than the NASDAQ there. New York Stock Exchange down a little bit, NYSE. Small caps and mid caps both down roughly about 0.5%. So they've been seeing a little bit of relative strength this morning. They're seeing a little bit of relative weakness. I suspect that could change if we start to see another drop in the semiconductors today. That could be another opportunity in the morning here with the small caps. So keep that in mind. The VIX down here still in the 13s. So even though we have been seeing a lot of selling, a lot of scary selling in the semiconductors, and we've seen the market roll over a little bit, still sitting very low on the VIX down around 13, which to me remains extremely bullish. All right, that's all I have for today. Please click the like button and also hit that subscribe button and follow us here at Earnings Beats. We love having you. We're trying to build this YouTube community, and folks like you are helping us do that. So spread the word to your friends, folks you know that enjoy the stock market. Have them check us out. I do this for a reason, try to give back to the community. I know a lot of people can't afford our service. We try to do it for those folks to try and help them in their pursuits of a better future. Anyhow, have a great day, everybody. Happy trading.